It's 1912. You're standing on the deck of the most expensive cruise ship ever built. The band is playing. Champagne is absolutely everywhere. And the captain has just announced that nothing can sink this vessel. And in the radio room, somewhere below your feet that you've never been before, a wireless operator is receiving the 7th iceberg warning of the evening. The first 6, politely filed, politely ignored. The captain is in the dining room after all. Now, you don't know any of this, of course. You're up on the deck. You can see the moonlight, you can see the ocean, you can feel the waves. Everything looks absolutely magnificent. The ship you're standing on right now is the global financial system. And it's just received its 3rd iceberg warning of the evening. Bank of America, not a doomsday cult, not a weird uncle on Facebook, one of the largest financial institutions on the planet just sent a private note to its institutional clients. And in it, they described 4 emergency alarm levels. Tripwires, the financial equivalent of icebergs in the dark. Now, 3 of them have already been triggered. The 4th, the one that starts the real panic, is one bad news day away. Now, you're probably not going to hear about this on the evening news, because the evening news is way too busy explaining what celebrity wore to a divorce hearing or something else like that. But you, my friend, you are not on the evening news. You're here. Thank you. So let's go on and have a polite word with the captain, shall we? Has anyone ever told you that the stock market hitting record highs isn't actually always good news? Because the Bank of America has a name for what's actually going on. And the name is this, and I promise you this is verbatim, I'm quoting it. I didn't huff anything before the recording. They're calling it an upside crash, which is the financial equivalent of someone sprinting towards a cliff, looking back over their shoulder and shouting, "Great cardio, guys, great cardio." But before we go any further, 2 minutes on the credentials of who you're listening to. You're trusting me with the next 12 minutes or so of your life, and I owe you a reason to do so. I've spent 25 years in financial markets. I've worked in the City of London, I've worked in some of the biggest investment banks, and back when interning at an investment bank meant being shouted at by a man called Nigel, not being given a mental health webinar. I have watched this exact same setup before. Oil spiking, yields rising, concentration risk building up. Twice in my career, both times, the people who weren't paying attention got, and I use this in the technical financial sense, absolutely vaporized. You are paying attention. That's already statistically better than 90% of the average retail investors in these markets. Now, I've got 4 steps for you, 4 pivotal steps, but you're going to want to stay until step 5, because step 5 is the part that nobody, not the Bank of America, not Bloomberg, not JP Morgan, not Goldman Sachs, especially not your financial advisor who charges you 1.5% to underperform in index funds. Nobody is telling you these things clearly. So let's talk about these tripwires. Michael Hartnett, Bank of America's chief investment strategist, a man who looks like he hasn't smiled since 2007 for very good reasons we'll get to later on. He published a note in 2026, and in it, he laid out 4 specific market levels, emergency floors, to conditions under which Washington or the Federal Reserve would be forced to do something. Here they are. I'll go through them quickly and try not to scream. Keep your arms and legs and limbs in the ride at all times. Tripwire 1, oil above $100 a barrel. That's been triggered. Tripwire 2, the US dollar index above 100. Also triggered, check. Tripwire 3, the 30-year treasury yield above 5%. Yes, we've got 3 for 3 so far. 4.9% when Hartnett wrote the note, and now over 5% again. About as reassuring as your smoke alarm going meep instead of beep, beep, beep for now. And Tripwire 4, the S&P falling below 6,600. I know, not yet, not quite yet, about 5% away, which sounds comfortable until you remember that markets can fall 5% in an afternoon if someone in Tehran says the wrong thing into a hot microphone. So, 3 of the alarms are going off in a building you live in. Would you sit on the sofa sipping a beverage and wait politely for the fourth? No. You would, at minimum, wait to know which exits are working. So let's check the exits. Now, here's the part that I'm going to mess with your head a bit. And I say that with genuine affection. Now, the stock market, it looks magnificent. I can't lie. The Nasdaq just logged 13 consecutive days of gains recently. It's the longest winning streak since 1992. The year that great film Wayne's World came out, that's how long it's been. Think back like that. The S&P 500 is above 7,100. It hit all-time highs. Champagne on the deck of the Titanic while they rearrange the deck chairs. You are looking at that and thinking, great, everything's fine. I'll go put on the kettle. And you would be exactly the kind of person Bank of America is gently weeping about right now. Because here's what their derivative teams actually called this: an upside crash. A crash going up. Which is the kind of phrase you invent when you're 3 Red Bulls into a Sunday night and the Bloomberg terminal is screaming and your spouse is asking when you're going to bed. In plain English, and I refuse to write financial English because it was designed by people who get paid more if you don't understand it, an upside crash actually means this: prices are rising so fast that professional investors are being forced to buy. Now, it's not because they think anything's worth the actual price. They're acting more like Wile E. Coyote, running on air, looking down. The plummet has already started. They just haven't really accepted it yet. Bank of America surveyed 210 institutional fund managers, controlling over $1 trillion of other people's money in May 2026. After all of those record highs, they barely moved their equity allocations. That's the professionals, the people who manage the money of small countries. They're not buying the rally. They're watching it all from a very, very safe distance, like you watch a stranger argue with a vending machine. And when you see that, the professionals who are standing very still while the market sprints, that feeling you're experiencing, how can we characterize it? That low hum of, this seems too good to be true, surely. Now, that's not paranoia, that's pattern recognition, and that's you being instinctually and gut correct. Now, a lot of the issues that we're facing right now is to do with oil, the oil markets. Let's talk about oil, because this is where the story gets geopolitically, inflationary, and structurally insane and unhinged, in roughly that order. Now, the United States went to war with Iran, and tanker traffic through the Strait of Hormuz, that narrow, deeply unsexy strip of water through which roughly 25% of all the world's oil supply passes every single day, that traffic essentially and effectively has ground to a halt. And since then, Brent crude has risen more than 60% this year. It's now trading above $100 a barrel, which, if you've been keeping notes at home, and I assume you have, is tripwire 1. Triggered, checked off the list. But here's where it gets deeply, deeply conflating and deeply concerning. Uncomfortable for everyone who hoped the Federal Reserve would ride to the rescue, sword drawn, and keep the low rates flowing. Now, 6 months ago, the probability of a June 2026 Federal Reserve rate cut was priced at about 100%. Done deal. Fait accompli. Definitely going to happen. Already in the calendar, already in the spreadsheets, already priced into the markets and asset prices, already cracked open the celebratory wine or whiskey. As of now, it's only 25%. It collapsed almost overnight, like a souffle in a slammed door. Why? Because oil is above $100. Inflation cannot go down in that scenario. It goes up. And the Fed, supposedly the all-powerful wizardry behind the curtain, they can't cut rates and usher Dorothy or Toto back into that sweet, fair morning. Nobody on the Federal Open Market Committee wants to be the person who explains that we cut rates the week before inflation started going to 7%. They'd have to explain that to their grandchildren and to their children. You know that particular flavor of helplessness that we're all feeling right now. The one that whispers, someone, I don't know who, will surely fix this. That feeling has a clinical name. It's called institutional dependency. And right now, the institution is unavailable, and they're asking you to just please leave a message after the tone. So, Let's talk about the stock market that you think you love and that you think is protecting your future. The S&P 500, America's biggest companies, diversified, right? Safe, the sensible thing to put your money in, according to roughly every single financial advisor your parents ever met at a golf club. Here's the thing about diversification though. It only works when the eggs are actually in different baskets. Right now, the Magnificent Seven stocks, the Nvidias, the Microsoft, the Metas, the Google, the Amazon, the Teslas, they're accounting for about 40% of the entire S&P. 40%, 7 companies out of 500. That's like buying a fruit basket and discovering that 40% of it is one extremely large, slightly aggressive avocado. And Nvidia alone, in 2025, it accounted for nearly 16% of the S&P's total gain. One company, one technology theme, almost a sixth of the entire upside of America's most important financial index. For a year, that's a problem. And here is the observation from Hartnett that made experienced people on Wall Street and retail traders put down their double espressos and read the note properly. He said in 2026, asset performance is, his exact wording was, more ominously close to the price action between the mid-2007 and mid-2008 than any other period in recent history. Now, what happened in that 12-month window in 2008? The crash, obviously. Oil, it doubled from 70 to 140 a barrel, while structural problems were quietly building underneath, like a leak in your ceiling you keep meaning to call someone about. Sound familiar? Now, the Iran war started in February 2026. Oil has already risen 60%. And underneath the $38.5 trillion in national debt, a Fed that cannot cut, professional investors politely declining to participate, and a stock market balanced on the shoulders of 7 companies. The only difference right now that I see between 2007 and now is that in 2007, nobody sent out a report warning about it all in advance. This time, Bank of America did, and it went to institutional clients, not to you. Until now, obviously, which is, I don't know, rather the point of this video. The thing that most retail investors do in moments like this, the thing that appears to be biologically encoded like a moth flying at, I don't know, a flame, is to look at the green numbers, feel reassured, and to do approximately nothing. Then when the 4th tripwire trips, you feel genuinely surprised. But it was at all-time highs only 3 weeks ago, right, guys? Yes, so was the deck of the Titanic. Briefly. When you see markets hitting all-time highs while the underlying alarms are sounding, the correct emotion is not incitement, it's caution. And it has been historically true, quite literally, millions of pounds to the people who got that distinction right has flowed to. Now, speaking of which, here's where this stops being alarming and it starts being absolutely useful. Because crashes aren't just catastrophes. They are also, and I say this fully aware of how callous and unfeeling it sounds, but I'm gonna say it anyway, guys, because it's true. The single biggest wealth distribution events in entire financial calendars are crashes. The question isn't whether the correction comes, the question is whether you're standing on the right side of the chainsaw when the kid on the other side of the seesaw suddenly gets off. Right, what should you do right now? Enough analysis, let's talk about you specifically, right? Here's the thing, I've watched history repeat itself for 25 years. The people who lose most money in corrections are not the people who didn't see it coming. They are the people who did see it coming and did nothing and then panicked at the exact wrong moment, which is statistically the bottom of the chart. I mean, it's always the bottom of the chart. And when you see oil above $100 and the treasury yield approaching 5%, they are not abstract numbers from a financial news ticker. That's your mortgage rate in 6 months. That's the cost of every business loan in the country. That's the margin compression in every company that uses energy and borrows money. Here is what the data actually suggests that you should consider. 1. Build a watch list. Quality companies, beaten down sectors with structural tailwinds. 2. Watch gold and commodity producers, not as a panic hedge, but as a deliberate and considered allocation to what central banks themselves are buying. 3. You should audit your exposure to government debt, to bonds. The 20-year plus Treasury ETF has lost 31%. If your pension or your portfolio is heavily weighted to those long-dated duration bonds, rising yields are not your friend, my friend. They are quietly removing your wealth and value while you sleep. Now, the question isn't whether the fourth tripwire trips. I mean, it might not. There are real things that could defuse this. A ceasefire in Iran, oil falling back below $80, the Fed finding a creative way to cut. Though they're all genuinely possible. But preparation isn't pessimism. Preparation is the difference between the people who look back at the next major correction and say, I saw it coming and positioned for it, and people who say, I had no idea, why did nobody warn me? Somebody just warned you. That was me. I just warned you guys, okay? Now, so if this video made you feel better, informed, or significantly more alert or worried, mission accomplished completely. That's literally what I was going for. Subscribe if you want more of this, because the world frustratingly refuses to slow down its production of alarming financial data. So there will, regrettably, be more beatings until the morale improves. Like if you enjoyed the upside crash concept as much as I did, which is to say, uncomfortably so. Comment below with the tripwire that worries you the most. Oil, dollar, yields, the S&P level itself. I read every single one, usually late at night when I should be doing something more relaxing, like sleeping or being, I don't know, a normal person. Now, until next time, you need to stay curious, stay cautious, and remember this one thing. The people on Wall Street who are nervous right now, they're not nervous because they're pessimists. They're nervous because they can read a chart. And now, so can you. Ciao for now.